Hello, I'm Greg Bonnell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, investors are focused on key inflation data out of the United States this week and what it's going to mean for the Fed's path on rate cuts. Plus, small caps in the Russell 2000 are gaining momentum. Lower rates could provide an extra boost. And our trading debaters are standing by. They got the bull and bear cases for Bank of America. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. All right, we're half an hour into the trading day. Let's get you caught up in the markets. Start with the S&P 500. We've got some modest green on the screen. The Nasdaq's been hitting new highs. It's been tech stocks sort of lifting us out of the, I don't want to call it the slump. I mean, we had a day on Friday that was a bit down, right? We made up for it yesterday, and we got some green on the screen today. It's pretty modest in that broader read of the market. Let's jump into the heat map, see if my theory holds true that it is the tech names putting points on the table. Well, it's not NVIDIA, but you got Microsoft, Google, Meta, some of the other plays showing a bit of strength, but some of the financials as well. Hey, we're talking about a financial today. Bank of America down there for about 1%. A lot of the other Wall Street banks putting some points on the table as well. Tech Resources, we'll take a look at the New York listing. Of course, this is a Canadian company. Anglo American is buying tech, one of the biggest mining deals in more than a decade. They've both agreed on both sides in terms of merging together. Not really a merger. They're getting bought. Tech's getting bought. $50 billion will be the combined company. Also interesting, too, that we recall Tech in the past has been able to push back from any buying offers because of the Keevil family. Currently, this deal has the support of the Keevil family. And talking about families, let's check in on shares of Fox Corp. The succession battle at News Corp is over. Rupert Murdoch and his children resolving that family feud. Settlement gives the favored son, that would be Lachlan Murdoch, broad control. It also ensures Fox News stays conservative. So the stock, you can see, falling off at the open. I started digging through saying this sounds like, the favorite son gets the top job. They're going to stay conservative. What's the problem? Well, to get the other three kids out of the family trust that controls News Corp and Fox, they got to sell shares of about $1.4 billion worth into the market for those three children leaving. That's a big share sale. So we got some pressure on the stock today. And that is your market update. Joining us now for more technical take on what is happening in the markets is Hiran Amin and special guest star Brian Rogers from our direct investing educational team. Gentlemen, welcome to the show and welcome back, Brian.
Oh, thanks, Greg.
Hey, thanks, Greg.
And before I get into the technical take, I want to introduce our live studio audience as well. We're fortunate today to be joined by our TD colleagues from the Wealth Contact Center. All of them are top performing leaders for Q3. Wave to the people at home. Great work. Thanks so much for being here. It keeps us on our toes. So let's get started here. Hiran, you're taking a closer look at the Russell 2000.
Yeah, it's all about the small caps, Greg. We've seen a little bit of price action coming out of the August doldrums, you want to call it that. We did see a bit of a rise there. For those who are uninitiated with the Russell 2000, it is the index that tracks 2,000 small cap companies in the U.S. and often viewed as the barometer for the health of the broader economy. Now, just a couple of trends I wanted to point out first before we go into the charts over here. We've seen an interesting momentum recently. Russell, in fact, rose to about 5% over the past month. That was in August, compared to NASDAQ's 1% gain. Also, when you look at a valuation standpoint, it trades at a discount compared to like the mega caps or the large caps. So right now, overall, that small cap is sitting at about 13.6 and the S&P sits at about 17.2. In fact, I think the last time we checked, it was closer to like the 20s. So this is about a 21% valuation discount, and we are starting to see a little bit of a mega cap rotation happening into the small caps, as evidenced with the lead up on there. Now, the other thing is going into these earnings projections for next year, which is key. Analysts are projecting about an 18.4% sort of growth for the small caps, which far outpaces the S&P 500, which sits at just shy of 10%, so about 9.8% there. So, and the last thing I will mention is diversification. We talk about that. We're seeing S&P is getting very much concentrated now. It's creating more of a diversification vacuum, whereas the small caps in the Russell 2000, they do give you a little bit more breadth in terms of industrials, financial exposure, and healthcare as well. So that could be a part of a little bit of rebalancing as we see the market shift there. When we look at the charts, though, It's telling an interesting story. So here's what's unfolded thus far. We saw it just before the new year hit these all-time highs at the 2442 level. That was the level that's the level to now breach, which is now acting as that resistance level. Then we saw it go down to this big slump. We saw the tariff news take a big hit on it. But what came out of that the tariff news and coming out of into June is we saw this inverse head and shoulders pattern form. Now, this is a bullish reversal pattern, which tells us we want to see a break on the upside, and we have a neckline that gets formed over here, which is creating that sort of resistance barrier, and it did so just in kind of mid-June. It broke through that. We see the measured move play out, where the next level they were supposed to hit was the 2300 level. Now, the 2300 level, coincidentally, was kind of where the highs were just sitting at early of 2025. It has cleared that. And now, going into its next leg up, this could be where its big moment is going to happen, is it's vying towards that 2450, which is going to hit the all-time highs. Now, if that does happen, that is really going to break down the bear structural story with the argument of, that being the resistance zone, and we could see a new price discovery happen being on that. So this is one to keep an eye out in the coming months, especially with lower interest rates coming around the corner.
Great work on the Russell 2000, because these are the companies that really feel the economy and the moves of an economy. September has got a bad reputation for the markets. We're not that deep into it yet. Yeah. What's the VIX telling us about
VIX is telling a different story though, Greg, right? Like you think that just based looking at the VIX, we've seen these sort of low levels. I've got the chart pulled up where we've kind of hit this downtrend. There's a wedge formation that's happened. Again, VIX, remember, just for those who are unaware, it's a fear index. It measures essentially the S&P 500's volatility over the next 30 days using some of the options pricing there. Now, typically with it hovering in the 15%, it's or 15 range, I should say, it really means the market's very complacent right now. It's a stress-free period, in other words, right? No one's really pulling their hair over the market. We've seen it hitting new all-time highs. S&P's always creeping up there. So with this being said, the market's not pricing a lot of long-term uncertainty, or short-term uncertainty, I should say, thus far. Now, the one thing that's interesting with the price action, though, we have seen elements of it within August and a bit of in September, where it's had these spike ups, where it's creeping towards that 20 level. But this wedge formation is also looking for a breakout. We want to see a breakout to the upside, where we could see a spike coming towards the end of the year. So some of the catalysts that could, again, bring the volatility back, we see in the closing months, typically we do see volatility tend to pick up. But it again comes back to the macro narrative. The dovish narrative seems to be all but sort of confirmed right now with the way the pricing is happening. But this week is going to be a pivotal sort of gauge to look at with the CPI numbers coming in. And if it comes in the hotter print, that could give the Fed at least pause to rethink whether they're dovish. The start of the dovish tone is what I'm going to say, and what future cuts might mean for the year following 25. So this is one to keep an eye on. We're looking for that breakout on the upside on the VIX and see if we do get a bit of an uptick there.
It's got a big decision on his hands next week. Brian, welcome back to the program. You've been on before. You're taking a look at Adobe, right?
Yeah. No, I want to say I love Hiran's analysis there. I love his big picture. It's great. So I am taking a look at Adobe, and the reason I'm looking at Adobe is they have earnings coming out next Thursday. And Adobe's an interesting stock in the fact that, you probably heard of some of their products, Photoshop, PDFs, like all those things, the Acrobat. They've been around for a long time. They're very established. But one thing that's interesting, Greg, I don't know if when you brought your report card home when you were a kid and your parents, if you had all A's, they'd be like, hey, I want A pluses. They kind of, they're
I thought you were going to accuse me of using Photoshop to fake my report cards. I'm older than that. Photoshop wasn't around in the 80s.
That would have been a great idea. Sure. Absolutely. But yeah, the point I'm making is the fact that the market seems to have really high expectations for Adobe. It's had about 75% of the time it's reported earnings. It'll have positive earnings, but it'll go down right after earnings is announced. So kind of that expectation is not there. And I think the concern is the fact that they're trying to integrate AI into all of those products. So I think they're a little bit slow to do that. They are saying that they are doing a much better job, so I think that's something to watch for with earnings. So if I jump into the charts here, you guys can see, I'm just taking a quick look at just the prices right now, crossing more recently the 21-day moving average. It did yesterday cross the 50, and it hasn't for quite a while. I have it off the screen here, but it hasn't touched the 200 for quite some time. But it is going in that direction, so I think we're watching for that as coming into earnings. And there is this year they did increase their forecast for revenue and earnings per share for the full year. So that's something I'm just watching that to see what happens. Hopefully it doesn't do that to, not meet expectations and do the big drop. And I think if it tests, if we look at support and resistance on the chart right now, if it does test this support and resistance, if you see it drop down and it goes through the 338 price range, we might see it drop even further. But I think if it comes up to the 363, where it's very close to right now, and then it breaks through that significantly, then we could have a little bit of a run up.
All right, interesting stuff, gentlemen. Thanks for that. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It'll take you to our TD Active Trader Live website. And once you're there, you can try out the TD Active Trader platform risk-free by opening a practice account. How do you do that? You just click on the Try TD Active Trader button. And then when you're ready to switch to a live account, you simply export your workspace and start trading for real. It's time for the main event, trading, debating. The stock in the spotlight this week is Bank of America. This is the second largest bank in the U.S. by total assets. Before we get going with the debate, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance, do your own due diligence before engaging in trading. Now let's get back to that stock of the hour, Bank of America. What made you guys pick this one to debate? Hear it.
Greg, you already took the words out of my mouth. You said it's the second largest bank in the U.S., of course.
Well, we could have chose the largest. So.
Oh, yeah, maybe that's the argument that we'll go with. But it's also a first on our show. I mean, we've covered the financial space. We did investment banking, Goldman Sachs way back then, but we never covered a traditional bank. So it would be interesting to obviously peel through the layers and look at that. And also the way the macro backdrop is shaping up, with the easing of potential interest rates coming around the corner, what that's going to mean for the industry. So I'm sure it's going to get a lot of interest in it, and I'm hoping that these results will yield positive benefits as well coming out of this discussion.
Now, Brian, you didn't so much choose as you were told. Hey, you're filling on the show. It's Bank of America. What intrigues you about the name?
Well, I think it's just it's kind of a household name, right? I lived in the U.S. for a little while, and I banked with Bank of America, and so it's on every corner. They're almost on every corner. It seems like it's something that's in the neighborhood, and the brand really well. But I think just digging into that financial, I think I was here last time we did the financial stock with Goldman
Sachs.
So I think, that was intriguing to me just to take a look behind the curtain on what's going on in the finances and the banking side.
Okay, so let's get some time on the clock. You each get your 2.5 minutes to make the bull and bear cases, then some time to counter. As always, we draw from the hat, and Hiran, he got the bull. Take it away, bull.
All right, so I'm going to start by saying, of course, I'm representing the bull camp today. Bank of America has really emerged as one of the preeminent U.S. banking franchises, and I would even go so far as to call it institutions in the world. It ranks among the heavyweights in U.S. finance. It does everything from personal banking to investment banking, mortgages, advisory service, and trading, of course. It has one of the best retail branch networks across the, footprint across the country, and it's a tier 1 bank. But also it owns Merrill Lynch franchise, which is its advisory service, one of the leading U.S. brokerages as well in the business. Now, there's a couple of things that I wanted to just focus on when it comes to looking at a bank. And the first thing is always when you're making an investment is you want to talk about profitability. How do you measure profitability for a bank? It's NII, net interest income. Let's talk about that a little bit quickly. So with the high interest rate environment, of course, that we're in, this supercharged NII. That's across the board. But the way that Bank of America has done it differently is, and for those who don't know what net income interest is, it's essentially the difference what the bank earns on loans versus what they pay out on their deposits. They've had a 3-year CAGR of 7% on their NII, and this is even before we had the rise in the interest rate. So that is simple, steady, and I would call it seductive at those numbers that you have. They also have an added advantage because they're going to be repricing a lot of their long duration loans and securities, which are currently earning low yields, and management is forecasting a further boost, about $450 million that's going to benefit NII in the next couple of 2 quarters there. The last thing I'll talk about is NIM, which is net interest margin. They sit at 5.3% versus the industry at 4.1%. So they are really creating a benchmark there. Let's talk about the charts. I'll leave some of my points on the table for the rebuttal there from Mr. Wonderful here. On the charts, we have a cup and handle formation. I'm on the weekly chart, and I want to show this because it's one of my favorite if you've watched the show. It's a bullish pattern that shows us reversal. It's broken out of this long sort of resistance area over 2022, and the measured move is indicating we can get up to the $60 level. I'm just going to switch over to the daily chart here, and we'll switch out candles to a daily candle chart and show you what's happening on this front here. So another pattern that's forming that we see a reversal, and this is the inverse head and shoulders. This is coming recently as of the April lows. We saw this head and shoulders being formed. This has been the touch points where it's resisted at these areas, hasn't been able to break through until recently. This is a key area that is broken to the 48 level. It is getting up to the 50 level now, and the next resistance is going to be that 50 level where we think we can push through.
All right, he is laid
Squeaked it in there.
Okay. Ryan, are you feeling good? You're laughing, or is that a nervous laugh? Aaron's
Maybe a little bit nervous. I'm sitting beside the expert here.
All right, so give us the bear case, my friend.
Well, I think my case comes down to fundamentals, Greg. To use a banking acronym, I think the bull case is overdrawn. For sure. So, fundamentally, they're waving a few huge red flags, and I may get into that later. I'll save that for a little bit later on. But, if we look at just kind of some of the qualitative and quantitative things, there's been several executives that have jumped ship. To use that analogy, I think Bank of America is becoming a little bit of a leaking ship in that case, where they've got some huge regulatory fines that they've just incurred recently. And at the same time, they're building, you mentioned the branch network, the retail network, they're planning on building, they're spending a ton of capital on building another 150 branches across the U.S. But right now, I think it's around 95% of their interaction is through digital. So their clients are, these digital clients, they're not really coming into the branches, but they're spending money. So that's a big gamble that they're trying to take. So the other thing is that, actually, let's jump in. I'm going to jump into the charts right now just to show, in terms of nothing like a cup and saucer or anything too fancy, but if we jump into the charts, we can see that the price more recently has crossed. So it did come up to a new high recently. So I think it's right now it's adjusting to the fact that the market's saying, hey, we're going to come off these newer highs. You can see there was some big drops, some big base candles that dropped recently, but they also dropped below the 21 and the 50-day moving average. And even further, it's dropped now a couple times more recently below the 200-day moving average. So you can see there's some weakness now, coming up in the chart. And if we look at, if I take a look at an indication here that's pretty interesting, it's called a black crow. And I know, Greg, you like your rock stuff. It's not Black Crow. It's not the band or anything. But there's a group of candles that you can see. When you see significant, largely based candles that I've highlighted here, especially when there's 3 in a row, that's usually an indication of like a bearish reversal. So that's something that I noticed in the chart. So just that combined with the fact that they have, as I mentioned, some fundamental things that we can probably discuss a little bit later, but also just that the spending on the capital. You were mentioning their income, their revenues have kind of trended up, but then their income I don't think is kept pace as a percentage. So that's really it at this point.
10 seconds left on the table. I think he's feeling
feeling
pretty secure in his argument. Time to give a little back and forth. Give me the back and forth. Here, someone's got to speak first, so Aaron, speak first.
All right, so I'll address it first. So talking about the franchise and the retail footprint that they have, you have to understand with the way that Bank of America has structured it, 3,700 locations, they are looking at efficiency. So they're actually a bulk of where they're growing market shares, where they're focusing their locations, and that's the 5 or the 6 biggest metropolitan areas in the United States, and that's where their focus is. So they're still getting traffic. And yes, there is digital adoption, and in fact, I wanted to talk about that because you mentioned that we talk about AI these days. How is it actually unfolding in the banks that we have? And BAC, in fact, was rated the top U.S. consumer bank for using AI by Global Finance magazine. They have Erica, and we're wondering who's Erica? Well, it's akin to Bank of America's version of Siri, essentially. It's Erica. So Erica is voted the best chatbot of virtual assistants in the US and North America. It does everything. It tells you about how to manage your spending. It gives you recommendations about investing, not per se buy or sell, I would hope, but just advice. And also helps you understand increasing about savings. So they have about 3 million client interactions. So think about the efficiencies in terms of how they're structuring the overhead or the cost structure just with having AI use in here. And 58 million in
you're being awfully generous.
Yeah, I'm giving them some time. I'm looking at the clock there. I better jump in here.
Jump in, Brian.
I was going to say, you can't spell America without Erica, right?
There you go. Look, it's written all in there.
But they are spending a ton of money. So I think that's one of those things, that capital I mentioned with those branches and that spending on AI. They were the only major U.S. bank to miss revenue in Q2. So they are growing revenues, but at the same time, if you look at that bottom line, the last 5 years, net income, so the bottom line, has stayed the same. So it's one of those things, they're spending a lot of money. Maybe that will pay off in the future, but right now, there's this indication where they're spending a ton of money, they're increasing revenues, they're getting those sales, but the cost of those sales is something that's really
what you're
impacting
talking about. When you talk about revenue and you talk about this capital expenditure that they have, don't forget you have to look at one of the biggest things is return on equity that you have, which is the efficiency measure. So it's looking at the assets that they have, combining, the liabilities they have, and what are they getting shareholder return of equity. Currently, that sits at about 10.3%. They're actually benchmarking higher than their median over their historical period, which is 9.3%. And that's really powered by loan growth and higher net interest income. So yes, they're doing CapEx spending, but they're also improving their returns, and they're being more efficient with how they do their spending as well. In terms of revenue growth, I have slightly different numbers. They've been growing on a trailing 12-month basis, 9.4%. On a 3-year average, it's 7.2%. So the top line is increasing, and the net profit margin has always maintained at 26.9, which is in fact better than its competitors. I won't say it's better than JP Morgan, which stands as the number one.
One thing I got to jump in on here first before we get to the end is all those things can be hidden in a way, that net income and revenue, you can hide some things, but cash flow, cash is king. Right now they've operated with a negative cash flow last year and an even bigger negative cash flow when it comes to free cash flow. So I think that's a big concern. You can have a household that looks good, but there's no cash left over.
Look at the way he did that. Tactician. He just nodded right at the end. It's like it's only 20 seconds left. Cash flow.
Yeah.
Well played.
They always got to throw in cash, Greg.
Yeah.
All right, so we've had a nice little debate here. Time to go into the platform, talk about possible option strategies. We'll start with the bullish trade. How could you play it?
Yeah, so let's go into the charts first. Let's map out where the price action is showing up here. So I'm starting with where I marked out my resistance support areas, kind of where the momentum indicators are shaping up. As I said, we broke through a key, this is very finicky here, but a key level was that 48 level, which was resisting for throughout this entire year. We did see a sort of swing off of that level, but I do see that with the next few quarters that they're coming in, what they're projecting it to break through the 51 level, and based on analyst price targets, we're sitting in that average about mid 55 and upper numbers at 60 to look at participating in this long-term growth. Now I'm going to just pull up this chart and the strategy just for a moment. What I'm considering doing, or a bull could consider doing in this case, if you have a long view on the stock, is to do a synthetic long position. Now, a synthetic long is essentially mimicking like buying the stock, but you're using options to do it. Now, the way we would do this in this case is you'd want to IO level. So in this case, we're going to be buying a call and selling a put, and it's going to be the exact same strike price with the same expiration date. In this case, I've chosen 48. I've marked this level out, still on the daily chart. As I see, if it does swing low, which is coming off of this high, we could see a bounce off of it and then continue on with its momentum that we have here. So the expected move, they have earnings coming out in October, but we're looking far out with December just to minimize, when it comes to options, the one thing that's against you when you're doing a net long position is time value. So how do you sort of mitigate some of the effects of that, and you just want to buy more time, and that'll reduce it. So we're going to the December cycle to look at it. We've got the 48. Right now it's queuing, okay, jumped up on me overnight, but what we're looking to get in for is about roughly $1.29. In fact, the stock is up 64 cents, which explains it. So that's where we want to look at getting entry into this position. So essentially my cost is $1.90 on a single contract to enter this long synthetic position over here. And the last thing I'll mention, Greg, is why choose a net debit position? Why are we paying for this? Because right now, as we explained with the VIX, it's very complacent. We're seeing low levels, which means that options are going to be sort of more conducive or more advantageous to be going net long, especially if you expect volatility to expand into that time. And it's been very low for Bank of America. It's about implied volatility sitting about 9%, where historically it's in that like 14% range. So we expect that to go up. So that's kind of the bull trade to look at.
That's the expectation. Doesn't go your way. What have you put on the line?
Yeah, so whatever we're spending is what we're putting on the line. This trade is a little bit different as well. So there's a couple things here. One is we're looking at the 48 level. So we need to factor in the cost that we're paying. So it's $1.90 is what we're looking to get into. So we need the stock to push up to at least $49.90 to start being profitable. But if it doesn't, it goes the other way. We start losing money. The biggest risk, of course, is downside risk on this trade because we do have a uncovered put position in there. So, should the worst happen and Armageddon take place and Bank of America goes to zero, that's what we're going to lose. We're going to lose our cost, which is $1.90 plus the 48 drawdown. So $49.90 is the max we can lose in the worst case scenario that could happen.
Okay, interesting stuff there. How could a bear possibly play it through options?
Well, as a bear trade, I'm looking at an iron condor. And the reason I'm doing that, Greg, is oftentimes Bank of America being a bank, it doesn't trade wildly, right? It's not really volatile. So the premiums aren't a lot. Like if you're looking at a more like volatile tech stock, that kind of thing, you could do something just like a bear call spread as an example. You're just hoping if I'm bearish, hoping that the stock doesn't go up above a certain level, and I'm going to keep those premiums. But since there's not a lot of premium, I can do an iron condor, and I'm doing 2 trades, one on both sides, so that I'm going to get a little bit of extra income, and I'm hoping it stays within a range. Because I am bearish on Bank of America from obviously from this debate, but I'm not super bearish. It usually stays fairly neutral in a way. It goes within like a $10 range. So if we jump into the trade, jump into the chart, sorry, we can take a look here, and here I've got some support and resistance checked off on. This is about the next 100 days. We're looking at around a $50 support and then around a $47 resistance. So if I can keep it within that range, that's where I was looking at a trade that would be between that 50. If it stays between 50 and 47, then I'm going to get to keep my premiums. And I'm hoping where it's going to draw down towards 47 or towards the middle here, you can see. And actually, if I change the indicators on here as well, I want to show, if I show the Bollinger Band and RSI, you can kind of see, it's bounced off the top here several times on RSI most recently, and it's touched the upper band of the Bollinger Band. So that's where I'm thinking it's going to go back towards the middle and down towards the bottom. So it's going to have a bit of a dip. And I've got the trade. I can show the trade right now, just down at the bottom here. You can see if I go to the option chain as well, we can see, here's the premiums. There's not a lot of premium typically. This is going out to about October 24th. So what's that, around 45 days? So I've got about 45 days where I'm looking at a 50 is the first credit that I'm doing on the call side, and then I'm doing a 47 on the put side. And then it's a $3 spread that I've got at the moment. So basically the risk is about $300. And if you can see on here, I can collect about $1.14. So that's even at what they call the natural. I could even get a little bit higher. It could go, if you see down at the bottom, you're up to about $1.60. So I'm going to get about $160 potentially. That I probably wouldn't get filled at that. More likely about $110 to $115, and risking $3 if it goes the wrong way. Because it could go way up or it could go way down, and I'm still going to get to keep the premium, but I'm just going to have the risk on one side.
And there's your risk, that $3, right?
Yeah.
Okay, interesting stuff, gentlemen. Possible ways to play those 2 positions through option strategies on the Active Trader platform. Thanks for laying out those cases. That was Bank of America, of course. Just a reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock. Before we move on, Brian, you're going to elaborate on the earnings analyzer.
Yeah, it's really small on my screen, so hopefully, I don't know if we can zoom in. I'll make it a little bit larger.
Yeah.
So I'm on the earnings analyzer in Active Trader, and the reason I wanted to bring this up is because we are talking about some of the stocks like Adobe has earnings coming up. Bank of America is not for a little while, but if you are looking at an earnings play coming up soon, I know Hiran mentions all the time. He mentions the at the money straddle, so you can look at it. For past earnings, like this is in April and July. This is looking at Bank of America. You can see what was the expected move. So you can take a look at that. This is the purple column right here. So that's going to give that to you right away. It's charting the at the money straddle, and right in the middle is where the earnings is. So you can kind of get an indication. The other thing I really like is it's got a historical and implied volatility. So anybody trading options, the fact that this is looking at it not right now, but this is looking at previous earnings. What's happened? So you can see where there's that contraction or the crush of volatility, where you can see the red is implied volatility if we're looking back a couple months. And then you can see after earnings that it usually kind of comes down. So you can see how the stock behaves based on those earnings announcements. Like I mentioned Adobe, how it seems to always, if you look at this, you can see the drop all the time up in the chart. And then the last thing is you can really see a good idea of earnings per share, revenue, and income. You can see there's these little tiny dots, but you can see the trend of how they did on the forecasted versus actual.
Yeah.
Were you going to add something?
No. I was like, you can actually switch on the trend and it'll do the, if you hit that box.
Oh, yeah, you can do the trend lines here,
trend
right?
line, there you go.
Absolutely. Yeah. So yeah, just a tool that is one of many that you've got available. But if you're looking at trading in earnings and you want to look back historically, what happened, it gives you some good insight on what could happen potentially in the future.
All right, very powerful tool there. Okay, if you got a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, just send us an email to td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. So if you can't join us live, be sure to visit the YouTube page. You can catch up on all our previous debates. You can watch this one over again if you really enjoyed it. Links right there at the top, and don't forget to like and subscribe if you're there. All right, guys, before we wrap up, what are some of the key things that you are focusing on for the rest of the trading week? What is on your radars?
Okay, Greg, thematically, we're talking about macro again, right? This is the last piece of data that the Fed's going to have to ingest before they have the meeting next week and make the announcement there. And this week's all about PPI and CPI. So on Wednesday, we have the PPI numbers. CPI will be coming out on Thursday. And figures are with PPI especially, the expectation is to produce a slowdown in wholesale prices. So these are the input costs after a soaring jump in July that they had. And then, of course, the higher profile is going to be the CPI. Where's that going to be stacking up? And right now, the consensus headline inflation is put at 2.9% on a year-over-year basis. This does mark the highest level since January, though. So that's going to be something for them to consider. Now, when it comes to the tariff side of things, we haven't seen a meaningful spike in tariff-sensitive sectors, which does suggest that companies are sort of taking a hit to their margins. But for how long are they going to be able to sustain that, right? Before they'll have to start putting these higher input costs that get passed on to the consumer. So that'll be a key to look at. Now, we talked about the results for next week, which is the FOMC announcement. Right now, the Fed funds rate futures are indicating about 88% that there is going to be a 25 basis cut. Those questions about a jumbo cut, that's at lower, and we're still on track for 2 cuts. So that'll be something to keep an eye on. So if the tone changes with CPI, though, that's the key to watch out for. That could mean stocks are going to come under pressure this week, and the dollar could get a bit of a bounce. So that's what's to look at the end of the week. The last thing I'm looking at, though, Greg, is a Lennar Corporation.
Are they building homes? They usually build homes. People feel good with
They're building homes, but no one's buying. That's the problem. So the second largest home builder in the United States, they operate across 2 key businesses, the home building services and financial services as well. So they do provide in-house financing, essentially. They'll be reporting next week on September 18th. EPS expectations are $2.08, which does mark a 45% decline year over year. Revenues at coming expectation about $9 billion. Again, that's about a 4% decline there. Now, the big problem is some of the trends that are emerging there. So we've seen the average 30-year conventional mortgage in the United States, very different from how we operate here, sits at about 6.5% to 7%. This is when we felt the pain when the interest rates were high over here and we were on variables. I was one of those. So I felt the squeeze, but imagine feeling the squeeze for 30 years. You're going to have people on the sidelines not dipping into the market. And then you had also housing prices that weren't really budging there. So that just created like sort of an equilibrium where there's just no movement on it. In fact, the unsold completed single home new constructions climbed to a 15-year high in the June numbers, 119,000 uncompleted homes there. Now, Lennar is one of the most aggressive. They are trying to get ahead of this. They did throw a lot of incentives. They reduced their profits about 460 basis points, and they spent an equivalent of 13.3% on the final sale price for sales incentives. So on a $400,000 home, they were throwing about $53,000 and change just for incentives to get buyers in there. So what we are seeing, though, the home builders had a big bid up just coming out of last week because of the tone of the dovish tone that's coming with lower rates on the horizon potentially. That means borrowing costs are going to be lower for developers, for suppliers, and of course the end consumers who are going to be buying these. So we've seen a little bit of a parabolic action shape up through the start of this year. We've seen it actually break this 140 level now. This is a key level that it broke down at the start of this year, 2025. So this does mark a significant breakthrough. And expectation next week is about a $10.50 move, so it could be pushing up higher. We do want to see it kind of trudge along and inch towards that 165. So the big focus will be just looking forward for Lennar would be deliveries. They have a significant pipeline, about $6.5 billion pipeline of homes that they still have in the backlog, which is equates to about 15,538 homes. So we'll see some more notes on that and how they expect that demand to start sort of the pent-up demand to start, start taking some of the supply off the table there.
Yeah, housing demand is always a great way to sort of gauge the health of an economy. When I think about the global economy, your company, I always look to it as an economic bellwether for the planet. FedEx, are the boxes moving?
Yes, absolutely. And I know I'm interested in it because I usually see the boxes coming to my back porch. My wife's ordering a lot of stuff online, so.
She has it delivered in the back, right? Hoping you won't notice.
Yeah, exactly. Yeah, we don't want those packages to disappear either. But yeah, no, FedEx is on my radar, like you mentioned, and it's a bellwether stock, like you said. It's one of those ones that the industry looks at and investors look at because package volume kind of trends can give an early read on consumer spending, business investment, and just like global health in a way. So they're coming up with earnings. It's going to be on Thursday, September 18th. And they've done some really interesting things recently. They have a DRIVE program, which is delivering, it's one of those cool acronyms. It's delivering result, innovation, value, and efficiency. So they've had that in place for the last couple of years, but it's really starting, I think they're starting to see the fruits of that, where they've offloaded a less than truckload and LTL trucking group, the FedEx Ground, and so they're really looking at getting efficiencies within the package industry. So that's something interesting. If we go to the charts, I just want to take a look. You can see here there was a trend. There was a downward trend for FedEx for quite a while, from very beginning of the year down to May. And that's attributed in a lot of cases to just the tariffs, right? The uncertainty around tariffs, because they are globally and they're delivering things all over the world. But you can see it leveled off. It's flattened where they're in a fairly small range right now. I wish I knew where they were going to go direction. I know everybody wished they had the right answer.
I wish I knew the future too.
Yeah, I wish we had a crystal ball. But even looking at the technicals, it's one of those things you can see there was some weakness here. More recently, the price crossed the moving averages pretty steadily, but then it came right back. And it's been staying within this range. What I highlighted on this chart, you can see in the green and the red, is there's an expected move of about $20. That's the at the money straddle, with this earnings coming up. So that's the thing I'm interested on to see what's going to happen. And I think if there is a move one way or the other, then you could see some direction going further after that. So it's one of those things. Once we see the earnings come through, we'll see what the sentiment is, and then then you might be able to pick a direction after that.
Always a big one I have my eyes on, too, to fill out our storytelling across the various shows. Gentlemen, always a pleasure. Brian, great to have you jump in and
my pleasure.
Take the seat there, and I know you'll be doing a lot more in the future.
Yeah, look forward to it.
All right, that's our show for this week. However, as always, investors should perform their own due diligence before engaging in trading. Thanks for watching.